Welcome to Talk Dickers. Today we are digging into a really interesting one from this earnings season, Acuity Brands. They just reported their Q1 numbers, and what happened next was, well, frankly, a bit of a shocker. We're going to break down that sell-off. All right, so let's get right into the heart of it. You're looking at a classic earnings paradox here. On one hand, Acuity actually beat their profit expectations. But on the other hand, the stock got absolutely hammered. We're talking its worst day in a long, long time. So the big question is, what on earth did Wall Street see that made them hit the sell button so hard? Let's figure it out.
So first things first, let's just look at the raw numbers. Because, when you just glance at the report, it actually looks pretty darn good. Okay, so you can see here, adjusted earnings per share, a solid 2.2% beat. Nice. Revenue? It was right in line with what everyone was expecting. No surprises there. But the real story, the thing that initially looks impressive, was all about profitability. And this is it, right here. The standout metric was that adjusted EBITDA, over $211 million. That's a huge beat, almost 7% better than the street was looking for. Now, what does that tell you? It screams that these guys are running a tight ship. Great cost control, fantastic operational execution. Management really seems to have a handle on things.
So if everything looked so good on paper, we're back to that big question. Why the brutal sell-off? Well, the answer isn't in what they did, it's in what they said was coming next. This is a perfect example of a market that was priced for perfection, and they didn't get it.
During the earnings call, management laid out their plan. They said, hey, we're targeting about 0.5% to 1% of operating margin improvement each year. Look, for a company this size, that's a solid, respectable goal. But, and this is a big but, it's not the kind of explosive growth story that gets investors fired up, especially when the stock was already flying high.
And this right here, this is the whole story in a nutshell. It's all about expectations versus reality. What did the market want? A beat and a raise. A great quarter followed by them saying the rest of the year will be even better. What they get? A beat, and then management just said, yeah, our old guidance is still good. Not what you want to hear. The market wanted to hear about a booming recovery. Instead, they got told about a tepid lighting market. Ouch. And finally, they wanted confidence, but they got caution about backlog normalization. That's just a fancy way of saying their big pile of back orders is shrinking, which could mean a weaker Q2 is on the way.
So with that disconnect, how did the market react? Well, investors basically had to reprice the stock on the fly, and let me tell you, it was not pretty. The verdict was swift and, brutal.
I mean, just look at this. The stock gapped down at the open and just kept on falling all day long. It closed down almost $50 a share in one session. That is a massive amount of market value just gone.
And here's the kicker. This wasn't just a little panic selling. The volume was huge, almost double what it normally is. That tells you something really important. This wasn't just small-time investors getting spooked. This was the big money, the institutional players heading for the exits with a lot of conviction. They decided the story they'd bought into was over.
And to make things even more interesting, the drop was way bigger than anyone expected. The options market, where traders bet on how much a stock will move, was pricing in about an 8.5% swing. The stock actually dropped 13.5%. It totally blew past those expectations, which means a lot of traders got caught completely off guard.
Oof. Okay, so after a day like that, a major repricing, the big question now is, what's next? Where does Acuity go from here? Let's get into our take on it. All right, here's our analyst take. First, for Q2, we're not expecting any big surprises. The results will probably be in line, and we bet the commentary is going to stay pretty cautious, especially with that backlog shrinking. Second, what does that mean for the stock price? Well, it's probably going to be stuck in a range, likely in the low 300s. It really needs a prove-it quarter to get that upward momentum back. So what's our rating? We're starting coverage with a market perform. Look, it's a well-run company, for sure, but right now the upside just doesn't seem to be there in the short term.
So that's our breakdown of Acuity Brands. And of course, just a reminder, this is not financial advice.